Hey fellow investors, in my previous two classes I talked about what are important to Warren Buffett when he was looking for wonderful companies. First, the company needs to have wide economic moat. Second, the company better to be assets light and have high return on invested capital. Today I talk about the third point for Warren Buffett, what is important in looking for high quality companies. It is growth. Yes, growth. The growth of the business. This is the third important point for Warren Buffett in looking for wonderful companies. The growth I'm talking about here is profitable growth. So if a company is growing profitably, its value also grows. And it's actually like that. As time goes, the value of the company grows, and it's good for investors because value grows, the difference between the value and price will expand if the price stays the same. So it will, over time, drag the price up, and the investors will get high returns with the stocks. So growth is the third most important thing for Warren Buffett. You may wonder that we all know that Warren Buffett is the most famous, most well-known value investor. Why he wants growth? Yes, value investors still want growth. Even in his very early years, Warren Buffett liked growth. And when he was 21, he wrote an article. He says, "The security I lack best." He was talking about Geico. Geico was still a very small insurance company at that time. In the article, he discussed why he liked Geico the best. Growth was one of the most important reasons he gave. Of course, Warren Buffett was right on the growth of Geico. And today, Geico is the largest car insurance company in the US. And it has rewarded Warren Buffett tremendously. You may wonder why value investors talk about growth. Yes, value investors love growth too. Because when a company grows, its value grows. And to me, there's no difference between value investors and the growth investors. Maybe growth investors are more aggressive on valuations, but value investors want growth too, and want profitable growth. I agree very much with what Charlie Munger said. He said, all investing is value investing. Yes, all investing is value investing, and everything else is speculation. So where can we find a company is growing or not? Again, you can come to GuruFocus.com and look for the growth rate in the 30-year financial page of every stocks. And for instance, in this case, I entered Walmart. You can see the 10-year growth rate, the revenue growth rate was about 5.1%, and 5-year average growth rate is 4.4%. The EBITDA growth is only 1.1% for the last 10 years, but over the past 12 months, Walmart has been doing much better. And if we look at Apple, we come here, we can see that for revenue over the past 10 years, Walmart grew 21.7% a year, and the growth has slowed down some for the past 12 months to 11%. The EBITDA growth was about 22.4%, and the growth also slowed down. Of course, you can come here to see the detailed numbers, the revenue per share, the EBITDA per share, and the EBIT per share, and earnings per share. So from all this, you can see the growth rate. You can click it open now, so it tells you the 5-year growth rate as well. We even draw a trend line there. So this is a place you can find the growth rate of every company, no matter it's in the US or in other countries. To see the correlation between the growth rate and the stock performance, we did some statistics again, just like we did for ROIC in the last class. You can see that this is a growth rate distribution for all the companies that are traded in US market and in Chinese market. We separate all the companies in 10 groups. In each group, we have the same number of companies. The first group is the top 10% of the fastest growing companies. The second group is the second fastest growing 10% companies, and so on. The last group has the slowest growth for the past 10 years. From this chart, we can see that Chinese companies usually have a higher growth rate, and US companies, this yellow line, has a slower growth rate. This, of course, because Chinese economy has been growing much faster than the US economy. And on average, for Chinese companies, the growth rate is about here, 12% around. For US companies, the growth rate is about 8%. And the first group, the fastest growing group for Chinese companies, it can grow 40 to 50%. These are the EBITDA growth rate. And for US company, it's about 26%. So it's much slower, but it's still much faster than the average of 8% here. Now we look at the stock performance of each group. We can see that the US stock has done the best. The fastest growing group, top 10%, gained more than 16% per year for the last 10 years. And the average group, which is about here, growed a little bit less than 10% per year for all the stocks in this average group. And then for Chinese stocks, although the companies grow much faster, but the stock didn't return as good. For those traded in Shanghai and Shenzhen, the average is about 8% a year only. If the growth rate is average, which is about here, it only gained about 1 to 2% for the past 10 years. The stock return was not that good at all. And for all the companies that growing the slowest and actually declining, the growth rate is negative. You can see that the stock return was also negative. So no matter in Chinese stock market or US stock market, as long as the growth is faster, the stock return is also better for the past 10 years. And here we don't even talk about the valuation at all. So as long as the company grows faster, on average, the stock return is higher. With these results, you probably understand why Warren Buffett wants growth in the wonderful companies he wants to invest in. Now, if we summarize what Warren Buffett wants for the wonderful companies he wants to invest in, the 3 points. First, the company must have broad and durable competitive advantage or economic moat. Second, the company is asset light and it has low capex requirement and it has high return on invested capital. Third, the company has profitable growth. These are the most important things for Warren Buffett when he was looking for wonderful companies. Now we come back to the sentence he summarized his investing. He said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Here we have talked about what wonderful companies are, and in my future classes, I will talk about what is a fair price. In reality, it's actually very hard to find companies that meet all the 3 requirements. And that's why once you find one, you want to hold on to it. You don't want to give it up easily. And that is also why Warren Buffett said, my favorite holding time is forever. That is why you want to hold on to a great company, because it is very hard to find one. Once you find one, you hold on to it, the value of the company will grow over time, and your share of value, of course, will also grow. And that's also why another great investor, Chuck Acker, has been doing. Chuck Acker lives on a small town which has only one red light, and he managed many billions. He has been beating the market for many years. Sometimes his company stock goes overvalued, but he still hold on to it. The reason is because it is very hard to find this kind of companies. I will talk more about Chuck Acker in my future classes, fellow investors. In this class, I talked about the third important point for Warren Buffett's wonderful companies, which is growth. And you can find the growth rate of any company on GuruFocus.com 30-year financial pages. Again, if you have any questions, please feel free to leave it in the comment area of this video, and I will get back to you in my future classes.